I'd like to thank the organisers for allowing me to attend this Congress. I've actually really enjoyed the first few talks that I've heard. And what's really important is that as an analyst, one of the issues I have is that we're meant to see around corners somehow to see what's coming around the corner in the future so we can make the right investment recommendations to our investors, our clients and the funds. But the problem we have is that we need also to be tooled up to have the right information at our fingertips. I think it's conferences like this which I find incredibly valuable to attend, to understand the perspectives from the innovators, i.e. the companies which are trying to make those real breakthroughs in the field. So I'm an analyst at Cenkos Securities. I've been an analyst since 2012 at that firm, building the healthcare franchise. Now, I started in the city about 12 years ago, having completed a PhD in drug delivery in the oncology space. So I have a broad scientific background, which I think helps in terms of trying to understand the nuances of this sector and how to relate that to quite often a generalist fund manager. So I thought it would be quite good to talk to you a little bit about Cenkos, just to give you some perspective. Cenkos is one of the largest independent investment banks or stockbrokers in the UK market. We are a firm which was established around 2005, assembling teams from some of the better and bigger teams in the City of London, so some of the bulge bracket banks. And we've built an area of expertise around raising money on AIM, which is the alternative investment market, which is the growth companies market in the London Stock Exchange. And we're focusing pretty much on becoming the go-to place to raise money for companies which are going public. So we don't do as much private financing, or we're trying to get into that space at the moment. What we focus on predominantly are companies which are looking to do IPOs, and those companies which are already listed who are looking for financing. So we tend to try and attract companies which we think have growth potential to deliver, sort of excess returns to the investors that we talk to. So over the years, Cenkos has established itself as the leading AIM fundraiser. We're number one in terms of nomad and broker across a number of categories. But what's important is that we don't limit the size of fundraisings that we undertake. We can do anything from sort of 2 million and historically to a 500 million tranche. And we're broker to about 60 companies. We also are, on our investment trust side, broker to a number of healthcare funds in Europe, including some of the biggest healthcare funds. So we're actively looking at taking the funds on so that we can raise money for them so they can continue their investments into the sector more broadly. We've actually made a good start to the beginning of 2013. I'm going to talk through shortly the progress I've made in building a healthcare franchise at Cenkos, and then I'm going to talk through the financing side and what I think are the critical inflection points that we need to consider when companies are looking to raise money on AIM. So, having started in January of 2012, we successfully built a stable of 8 companies within the Cenkos healthcare franchise. So it was a pretty tall order with respect to coming into a market which had turmoil, building a good client base, companies with market caps anywhere between 20 and 150 million market capitalization. We were fortunate enough to have an exit of a company called Proximogen, which is a small molecule therapeutics company in the area of Parkinson's and traumatic brain injury. It was bought by a private pharmaceutical company called Upshur Smith. The reason why I flagged that is because I've spent the last 5 years in the markets trying to talk to investors, engaging with them. There's a degree of cynicism out there because effectively people view biotech with a sort of a rear view mirror approach. So they're looking in the rear view mirror and saying, what about British biotech? When was the last time that Glaxo or AstraZeneca launched a blockbuster product? And what you've got to do is just have to kind of machete your way through that and try and engage with fund managers to get them to understand that the sector has a huge amount of potential to deliver, and a lot of these platforms are de-risking as we speak. So we took on 8 corporate clients, and 3 of them had a share price return of over 100%, i.e. many of them didn't just double, they went through a market capitalization of over 100 million. And why I flagged that point as well is because coming back to the biotech sector, again, people talk about biotech companies not having scale, but actually we delivered something which I haven't been able to achieve as 12 years as an analyst, which is effectively see a series of successful increases in value within the companies we looked at, which sometimes were unloved, but in the main, those companies were driven in terms of the returns that they demonstrated through clinical data, and that's something I'm going to come back to through the presentation. So if you look at the life science indices, within the UK TechMark Mediscience sector, which is a collection of our biotech and healthcare companies, last year was one of the best returns I'd seen for a number of years, 22%. This return was far better than the broader AIM market, and actually even the FTSE 100, which delivered a return of only 1%. If you look at the natural resources sector, which was sort of kind of the bubble which had been expanding over a number of years, given the high growth in sort of places like China, that actually went down pretty badly last year, delivering a negative return of 28%. So then if you look at the companies that we followed, we saw fantastic returns, and as I said, it was because these companies were delivering very good news flow. So our best performing biotech company was a company called Scancell, which is in the immune therapy space, not quite regenerative medicine, but within that fold. And they delivered a return of 700%, which was better than the best performing biotech in the US, which is Sarepta, which delivered a 500% return. So suddenly, last year, we were facing the situation where a biotech company in the UK was actually outperforming the best performing US biotech, which I think, for me, represented a sea change given the large amount of financing that venture capital firms are putting into the US, whilst avoiding to put that same financing input into the UK markets. If you look at the US biotech sector as a component of the S&P 500, the returns were spectacular, 35% for 2012, and that for me was the strongest signal as we came out of 2012 that 2013 had real promise. One of the things that was interesting to see in the beginning of last year was I was going around talking to fund managers and saying I believed, because I cover the pharma sector and biotech sector, that the whole pharma and healthcare industry was potentially going through a process of capitulation. Why do I say that? Because as an analyst covering the sector for 12 years, I'd never seen, during the course of 2012, in the UK, AstraZeneca, GlaxoSmithKline, Smith & Nephew and Shire all do M&A deals, not just one, but multiple M&A deals, and at the same time. And my argument was, when you see the industry capitulate, because they were not buying revenues to fill their patent expiry gap and the lack of productivity, they were buying products. They were buying pipeline products and technologies across the breadth of the phases, so phase 1, 2, and 3. And when you see that happen, when you see the industry capitulate and investors stand on the sidelines, that to me is the strongest signal that this sector has deep value, which is untapped. It's the strongest signal that not just sophisticated investors, and something I wouldn't say normally, but I think widows and orphans should be coming into the sector because there's deep value which is playing out. And so 2012 was a very important year. Now, it wasn't just a blip, because if you go into 2013, the year-to-date performance of the S&P 500 and the 52-week performance is equally impressive. We've got very clear positive signals in this sector, which I haven't seen, as I said, for a decade or more. And that, to me, suggests that I believe we've actually gone into a 10-year bull market in biotech. And that I don't say lightly. If you then look at the world markets in both biotech and pharmaceuticals, despite the perception that people were not making returns, the pharmaceutical markets delivered on a 5-year basis to the end of last year 65% using the Morgan Stanley Composite Index, which is a global index of returns. The world market delivered 17% in that 5-year period, and the biotech sector delivered 109%, an absolutely staggering amount of return for the global biotech market. If you then say, well, the UK is always seen as the sort of the poor cousin of biotech because, we have undercapitalized companies which are not well funded, we're not delivering enough value, it's leaving the shores of the UK and going elsewhere to be commercialized. The interesting feature here is that if you look at the UK biotechnology and healthcare sector, on a 1, 5 and 10 year basis, if you put £100 into that sector and reinvested any dividend income you received, you would have made, certainly on a 10-year basis, twice the return when compared to the UK small cap market, the North American small cap market, admittedly not just US but Canada as well, the European small cap market, and private equity. So I sort of My view is, when I talk to investors, is what are you crying about? The returns are there, they've been made. There are companies now, if you look at on the stock-specific basis, there are companies where you can make significant returns in the next 10 years. The final part to the puzzle, which is Europe, of course, is then you sort of have to argue, okay, fine, you're seeing those kind of returns globally, you're seeing them in the US, you've seen some of them in the UK. What's happening more broadly in Europe? So if you look at Europe and you look at the stock 600, which is the composite index of the top 600 companies in Europe, you can see that the returns in healthcare are 15% year to date. And the line going across the bars is basically the median of the stock 600, so that's your kind of benchmark. If you look at the PE multiple, which is basically a way of valuing these companies, comparing their price to the earnings, that's a multiple used to benchmark many businesses that are profitable. The healthcare index is trading at a premium to the median of the stock 600, which tends to suggest that the stock 600 average, or the median as you would call it, that P multiple is your benchmark. If you're then trading at a premium to that, and if I showed you the data for the first half of last year, it would look very similar, in fact. That doesn't speak to the fact that many investors view the healthcare sector as just deep value. It's returning to normal, reversion to mean, as they call it. So if the valuation metric was half of that light blue bar, you might say that the returns generated were just a technical return. This is a fundamentally driven return. This is very consistent with what I've been seeing for the last 18 months. So then if you say, okay, let's look at the subsectors. Let's look at individual components of the stock 600. What are the subsectors that are delivering? Is there anything that we can glean from that? The interesting fact is that within those subsectors, actually everything's performing, both on an earnings basis and a share price return. So on a 3-year review on the EPS level, it's outperforming the stock 600 on every metric, both median and on a mean basis. So again, you take away from that, there's a wholesale change in the sector, which is a positive dynamic. So coming to the actual focus of the presentation, the main question you ask, obviously, when you're looking at coming into the market is, what are the risks involved in floating a company? And I can say that I've been involved in IPOs of about 8 companies, and I've been involved in something like 25 follow-on or secondary fundraisings, raising in total about $800 million over a 12-year time frame. And there are three areas that I think you need to focus on when you're looking at bringing a company to market. The first is the valuation, because if you've got existing venture capital investors or perhaps some industry investors on board, it's very unlikely that as they've built that business and taking the risk in the early days, that they'll want to see the valuation crunched or come down. So they're looking for increases in valuation, particularly as they get to the market. The issue we have is that in the private market, valuations have very rarely changed over the last 5 years. Most of the valuations have either been static or been increasing slightly. In the public markets, it couldn't be more opposite. The public markets, the valuations typically of small biotechs have been coming off quite significantly, unless you're in the US, which I'll show you a bit data later on. And so valuation is a major issue for any entrepreneur bringing a business to the market. The second issue is going to be getting sufficient capital. Well, the problem you have is that a generalist fund manager, not a specialist fund, but generalist fund manager, they don't want to see you coming back every year to raise money. The challenge is then, can you raise enough money to take you all the way through a cycle to an inflection point, whether that's a trade sale or a licensing point? And the challenge therein lies in the fact that very rarely do you get enough capital to fund a company. And so my challenge as an analyst is to stoke up our sales team and to go out and talk to the fund managers and embrace them and get them to understand that they need to fund these companies, because a company with the same assets but 20 million more of cash on the balance sheet will be valued very differently if it doesn't have that cash. And then the other issue is raising sufficient capital. So if you don't have enough money to take your clinical assets through clinical development, you're then going to be delivering potentially poor clinical data or poor clinical results because you're undergeared in terms of the types of studies that you need to complete. So the secondary market, if you do successfully list the company, is going to be very important, because you need to have a good quality of investor, good levels of news flow to drive the liquidity, the number of shares being traded, and the valuation of the company upwards, because you don't want people investing into a company or investors coming into a company and then seeing them losing money within a month of making that investment. So it's very important to have good news flow post the inflection point of listing the business. And then the main costs, as I see them, are twofold. If you look at the management time involved in preparing to go public and the management time involved in seeing, various parts of the business which may not be looked after whilst you're away from the desk, that is an issue in its own right. So keeping a focus on the objective, which is basically getting the business into a healthy shape so you can step away for a few months and concentrate on listing the business, is critical. And then the other issues, of course, relate to the costs of doing the IPO, typically £500,000 in the UK, and it takes about 3 months to get to the market. So if you look at how fluid the stem cell market is, and the question of whether new business models are needed, I think that one of the issues we've got in terms of liquidity is that we haven't got enough stem cell companies which are listed, which have scale. So a lot of the companies in the stem cell market are sort of subscale. They don't have enough clinical assets in the pipeline, which is diversified, which gives people a kind of a risk management approach into the way in which they look at the company. They're not well capitalized as a result. It's clear that there hasn't been enough consolidation in the sector. One of the things that I'd like to see is a lot more public and private regenerative medicine and stem cell companies coming together, because there are bound to be synergies, not least overhead costs that can be reduced. But if you can build in a diversified pipeline of assets in a disparate number of diseases, diabetes, stroke, Parkinson's, whatever the disease areas are, but if you can build a level of consolidation into the sector, it will also allow investors to perceive that the risks are lower and that the business model can evolve into a successful venture. And then, as in the old days of biotech, when we had market caps which were in the billion. Celtech, which was our last big biotech exit, and once a FTSE 100 company. It would be nice to see companies coming to the market with a self-financing model, a revenue generation model, but it's extremely difficult because even biotech companies haven't been able to achieve that. But if there is a way for companies to generate income through sort of consulting activities or some sort of other methods of delivering products into the market, reagent sales or something like that, which can offset the burn to some degree, that would be very helpful as well. So what are the challenges in the regenerative medicine space? I think that one of the major issues that investors face today is the uncertainty of regulatory approvals. And I think that my heart tells me that the regenerative medicine space is probably going to be an area which is going to deliver real regulatory approvals, real successes going forward. But when I talk to institutions, they're very concerned about the ability for regulators to understand this space. And if you look at the cancer vaccine space, for example, Dendreon and Provenge as an autologous dendritic cell approach, the regulators probably had to go through quite a steep learning curve in order to understand the manufacturing complexities of that product, and also to understand how that product fitted in with the clinical data which was generated by more conventional treatments such as Taxotere. So the challenges of doing a successful IPO are more to do with de-risking the investment up front. So I've been advocating a greater participation from the industry coming into stem cell companies, and more participation also from non-dilutive sources of financing, grant income, because if you can get a grant from the Wellcome Trust, that stands as a kind of badge of honour. When you're coming to see an investor, they will take a lot of note of that kind of those kind of credentials and that sort of validation, because they always feel, and remember, most of the money in the UK market and the US market is generalist money. They don't understand the sector. It's not coming from specialist funds. You need to convince them, and one way that they look at being convinced is to understand that someone else has done the work and come up with a conclusion which they think fits with their investment thesis. So the biggest concerns you then face once you've got them over the hurdle of being comfortable with the regulatory passage to market is reimbursement. And increasingly, when I talk to pharma companies and large healthcare companies that are looking at regenerative medicine, they're telling me they're not so concerned to some degree with the clinical path and even the regulatory path. The thing that scares them most is the reimbursement path. And that's something that obviously we heard from Tygenix. 4 years, 5 years on, still trying to get nice to buy into the product is rather concerning. But I would hope that that will change as we get the high level of quality data coming through in this field. So then if you think about what kind of approach we can galvanize to generate further investment into the sector, I think it's very important to try and get a consistency of financing into the business. So effectively what you've got to do is get investors to come into the business, put money in, follow that money, and follow it to some degree in a more sophisticated manner, as in this is going to be a long haul. You're talking about 5 to 10 years in terms of the investment cycles into these kind of businesses before you see an inflection point. And I think that for me, once again, coming back to what I think really brings some kind of level of confidence into the business and into investment in this space, it's got to be some level of consortium backing. So I'm really pleased that the Catapult Fund, that they're actually looking at bringing in venture capital money and bringing in institutional money through the form of sort of pharma companies and venture funds, because I think that a consortium-led approach will be a way of minimizing and de-risking the entry point when generalists come in. And when generalist investors, i.e. the big pension funds and insurance funds, when they come into this space and believe in it, the pockets are very deep and they can put tremendous amounts of capital to work to even take companies in this space through with products through to market, which is of course something that we'd all like to see done more consistently. And then of course I think, given the M&A comments I made earlier, I think we've seen some very interesting M&A activity already with some of our bigger pharma companies, Shire and Smith & Nephew, a healthcare company obviously, through the acquisitions that Shire made with Advanced Biohealing, despite the slight bumps in the road that they've experienced with regards to the way that the product is sold. But particularly Smith & Nephew now jumping in with HealthPoint, with a great pipeline, phase 3 asset coming to market potentially in the next 3 to 4 years, but more importantly through some in-licensing activity with a company called Intercytex, having a product on the market in the wound care space, a regenerative medicine product which is out there selling, is really important as validation for the sector as a whole. And so this is probably the toughest slide that I could talk to, because I really don't understand this valuation discrepancy. When you look at pharma companies, when they go out and they buy biotech companies, there's only one price. They don't say, you're a Brit, or you're a US guy, or you're German, or whatever. They don't look at the geography of the company which they're backing. If they're buying assets, if pharma companies buy assets, it's probably on a global, strategic, long-term view that they're making that decision. And the price that they pay is the same. It's not any different. So the valuation points that I see in the stem cell space and regenerative medicine space are truly surprising still today, given the fact that some of the UK companies, for example, the company that Cenkos is broker to, Regenerative, is moving to a phase 2 clinical trial in stroke, and yet the valuations of some of the US stem cell companies, which are already well into phase 1, are a different valuation point. And it doesn't make sense. We've got to move to the point where, if a company has ticked many of the boxes, has a global platform technology base, has the ability to deliver a product which could go through a multiple of geographies in terms of the clinical trials, but it's going through a gold standard regulator like the UK MHRA or the EMA, you would think that the valuation differences wouldn't be that different. I would think that regenerative medicine offers us one glimmer of hope into the future, which is that everyone in this room obviously is a believer in this space, but people outside of this room should appreciate that they do have an opportunity to participate in what is going to be the most exciting area of medicine in the future, to deliver cures, not just treatments for symptoms. So just coming up to the last couple of slides, one of the things that I've been talking to, so I'm out on the road at the moment seeing some of the funds where our pension money is sat, some of the companies which we buy insurance from. So I'm talking to the biggest fund managers in the UK market and increasingly in Europe as well. And the message I'm giving them, because the thematic of my presentation, or the theme that I'm giving those fund managers, is regenerative medicine and immune therapy. So I'm talking about the third wave of biotech has already arrived, and that the landscape is building to deliver products that are not decades away, but have already arrived through Procamel in Canada, for example. But we'll see increasingly within the next 3 to 5 years more stem cell products coming to the market, and certainly more regenerative medicine or living cell products coming to the market as well. So the roadmap I'm giving them is look at the antibody space. If you go back 20, 30 years, you go back to the point where the antibodies were first generated, the IP was generated here in the UK, and you think about what held back that whole field, it's kind of simple and it isn't. When I was doing my PhD, which was in the polymer therapeutics area for drug delivery in cancer, my supervisor, I'd go to her and I'd say, I've heard about these antibodies, they seem really exciting, why are we not looking at them as well? And she'd say, well, as soon as you inject that antibody for a cancer patient, that antibody will be carried away. It will never get to the target because it's murine. It'll be scavenged by your immune system. Well, the tipping point for the industry, in my view, was when they made chimeric antibodies and humanized antibodies. So in other words, when we solved that technology issue, that bottleneck, we suddenly arrived at the point where those antibodies had significant utility, great utility in this market. And, it's not a surprise that if you go out 3 or 4 years, of the top 5 best-selling products in the world, 3 of them are going to be antibody products for rheumatoid arthritis, which are already generating, $6-7 billion of sales. So I view regenerative medicine as being coming along the path and coming along to the point where there is a technology inflection point, and it will be things like manufacturing, which are so critical to convincing regulators that you can actually get a product safely to the market which has consistency. But also you want a product which you can actually say is well characterized and which can give you further leverage in the field so that you can generate the kind of breakthroughs in terms of manufacturing that are needed in order to produce products at a decent cost of goods. Because if you haven't got a cost of goods of around 80%, you haven't really got a product that the industry will want. And so the sector outlook for me, and this comes back into regenerative medicine, and what I've been saying to investors is that, we know that there's big patent cliffs. We know that, the small molecules and the biologic space has gone through a series of sort of iterations. But if you look at biotech more broadly, and that's the only base we can point to in order to generate the interest in regenerative medicine, because we've got to get people to make money in biotech and pharma before they put more money into this part of the sector. I'm really pleased to say that, if you look at the last 52-week returns for some of these fantastic biotech companies, mostly in the US, you'll see that they've gone through significant re-ratings. We've got Gilead, which is delivering potential cures, for some patients in hepatitis C. And I talked to some of the biggest investors in Gilead, and they tell me that they think that product alone will generate between $10 and $15 billion of revenue. So we've got now biotech companies in this list, for example, which are bigger than AstraZeneca, which is a bellwether pharma company globally. And that really is interesting because it kind of speaks to the fact that maybe we're going to make more money in the sector through biotech. Maybe biotech companies will start buying pharma. But one thing's for sure, as more people make money in biotech, there'll be much more capital that will be available for more riskier investments into areas like regenerative medicine. So I continue to see real consolidation in the sector that will be generated in the coming years. We are in a bull market. I think all the indices tell me that. It isn't a flash in the pan. And I think some of the most exciting treatments I see coming through in regenerative medicine across the whole living cell therapy landscape give me a real pleasure and joy in championing this sector. And what I want to do is get the fund managers to agree with me on that basis.